Canada's big banks continue to inflate the crashing condo market and help prop up the real estate Ponzi bubble. For decades, the Canadian real estate market has been a paradoxical beast, a source of wealth for some and a mirage of unattainability for others. At the heart of this contradiction lies a systemic issue: the role of major Canadian banks in artificially inflating property values through their appraisal practices, particularly in the condo market, while stifling affordability for young Canadians. This is a story of how financial institutions have become both architects and guardians of a distorted market, prioritizing their balance sheets over the dreams of a generation. If you find this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis. The appraisal cycle, fueling the fire on the way up. When the market soared, banks played a pivotal role in amplifying the frenzy. Appraisals, the process of determining a property's value, became a rubber stamp for escalating prices. During the pandemic-driven housing boom, buyers competed fiercely for pre-construction condos, often paying premiums based on speculative future value. Banks, eager to lend, validated these prices by using comparable sales of nearby units sold months apart, even if those sales were inflated by investor speculation or FOMO-driven bidding wars. For example, a condo sold for $850,000 in 2020 might be cited as a comparable for a nearly identical unit listed 6 months later at $1 million, despite no material difference in the property. This created a self-reinforcing cycle. Higher appraisals justified larger mortgages, which fueled higher demand, which pushed prices further upward. By anchoring valuations to peak market transactions, banks effectively greenlit a disconnect between prices and local incomes, a gap that now becomes wider than ever. The blanket appraisal, propping up fiction in a falling market. Today, the market is cooling. Condo prices in cities like Toronto have dropped 10 to 30% from their 2022 peaks, leaving many buyers with units worth far less than their purchase price. Yet banks are now deploying a controversial tool, the blanket appraisal. Here's how it works. When a developer partners with a major bank, the bank appraises all units in a building at their original contract price, regardless of current market conditions. This allows buyers to secure mortgages based on outdated valuations, masking the true decline in value. For instance, in one example described in a recent Globe and Mail article, a pre-construction condo originally purchased years ago for $2.2 million is now worth $1.6 million, but the bank, near the time set for closing, appraises it at the higher price to avoid forcing the buyer to cover a $600,000 shortfall. Why would banks do this? Simple self-interest. If they acknowledge the true market value, their loan portfolios, packed with mortgages tied to overvalued properties, would face massive write-downs. This would erode their balance sheets, destabilize operations, and send stock prices plummeting. By propping up appraisals, they delay the reckoning, but at a cost. Young buyers remain priced out, and the market's natural correction is stifled. The affordability crisis, a generation priced out. The consequences are stark. Canadian home prices have ballooned to 9.3 times the median household income, up from 5.5 times in the early 2000s. Condos, once seen as entry points, now demand down payments that exceed years of savings for the average worker. Meanwhile, banks' refusal to let prices adjust downwards traps the market in a state of artificial rigidity. Consider the math. A 20% down payment on a $1 million condo requires $200,000. For a household earning $100,000 annually, which is above the median, saving even 10% of their income would take 20 years. Yet instead of allowing prices to reflect realistic incomes, banks double down on policies like extended amortizations, for example, 30-year mortgages, to make monthly payments appear affordable, a band-aid that deepens long-term debt burdens. The domino effect. Risks to the broader economy. This strategy isn't just unfair, it's dangerous. By delaying price corrections, banks are creating a time bomb of systemic risk. Mortgage renewal cliff. Over 1.2 million homeowners face renewing mortgages at higher rates in 2025. If their properties are overvalued, payment shocks could trigger defaults. Negative equity. 20% of buyers from 2021 to 2022 already owe more than their homes are worth. Further price declines could force fire sales, crashing the market. Rental market collapse. Investors relying on rental income to cover mortgages are struggling as rents fall 5 to 8% in cities like Toronto. Many may default, flooding the market with inventory. Banks' short-term fixation on protecting their books risks amplifying long-term instability, breaking the cycle toward transparency and equity. The solution requires systemic change. Independent appraisals. Remove conflicts of interest by mandating third-party valuations disconnected from lender incentives. Stress testing for banks. Regulators should force banks to account for potential write-downs, ensuring they can withstand market corrections. Policy interventions. Governments must prioritize affordable housing supply over demand-side tweaks like extended amortizations, which only defer pain. A market held hostage. The Canadian housing market is caught in a paradox of the bank's own making. By inflating appraisals on the way up and rigging them on the way down, financial institutions have turned real estate into a speculative asset class rather than a place to call home. For young Canadians, the message is clear. Until banks stop prioritizing their balance sheets over basic affordability, the dream of homeownership will remain just that, a dream. The path forward demands courage, to let prices reflect reality, to write down bad debt, and to rebuild a market that serves people, not portfolios. The alternative? A generation forever sidelined, and an economy teetering on the edge of a correction far more severe than the banks dare to admit. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.